As summer winds down and Wall Street returns to work, fixed income markets are entering a pivotal stretch. Issuance is surging, economic signals are mixed, and all eyes are on the Fed's upcoming meeting. Hi, I'm Dan Larkin. In this video, I'll share how we're approaching this moment in the market and what it could mean for portfolio positioning this fall. September has historically been one of the biggest months in the calendar year for new bond issuance. And based on what we've seen so far this month, we expect that to hold true again this year. The first trading day of September, for example, ranks as one of the busiest issuance days on record for the corporate bond market. And this was widely anticipated. Companies are looking to take advantage of this window where investor demand remains very strong and where their borrowing costs have come down relative to earlier in the year when market yields were higher. What makes this year more interesting in terms of a measuring stick for the market is that the yield advantage for investing in corporate credit today is smaller than the September levels we've seen over the prior 3 years. Now, so far, investor demand has more than kept up with this surge in supply, and that's helped keep credit spreads pinned down near record lows, but it's also kept our investment team more selective and more value conscious when looking for opportunities. Our analysts still view corporate credit fundamentals as very strong, but tighter credit spreads mean a smaller cushion for investors if the economy disappoints. Our strategy has been to use this wave of new issuance to add exposure to issuers that we believe offer value within a generally expensive market, with a specific focus on those that are more resilient to market volatility and to potential economic weakness. The economic data that matters the most for the bond market is the data that the Federal Reserve is watching the most closely. And that's really all around the health of the labor market and the path of inflation. Now, the August jobs report came in well below the market's expectations. The headline number missed by a wide margin, and the negative revisions to prior months were significant. Markets are now fully priced for the Fed to resume rate cuts in September and have also raised expectations for cuts over the coming months, now expecting about 3 before the end of 2025 and another 3 in 2026. We're looking at the latest economic data in the context of an economy that is realigning around lower growth, coupled with a job market that has less labor demand, but also less labor supply. For example, we calculate that the number of new jobs needed each month to keep the unemployment rate steady, also known as the break-even rate, has shifted downward from roughly 150,000 new jobs needed per month a year ago toward a level that we expect will settle around 50,000 by the end of this year. We see the Fed cutting rates twice this year, but don't expect them to have a preset course of sequential cuts once they resume. We expect this tension between a weakening labor market and sticky inflation to remain over the coming months, and we think that this mix will keep the Fed cautious and very data dependent. Overall, the economic data over the last few weeks has been tracking in line with our expectations for lower but still positive growth, which is a supportive backdrop for fixed income returns. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.